Today, we're doing a complete breakdown of ASC 230. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 230, cash flows were a mystery. Companies could hide critical cash insights. Imagine trying to assess a business without knowing if it's burning through cash. This standard brought transparency by mandating detailed cash flow statements. By the end of this section, you'll understand how ASC 230 revolutionized financial clarity. ASC 230 emerged to bring order to chaos in cash flow reporting. Before this, companies could obscure true cash positions, leaving investors in the dark. By segregating cash flows into operating, investing, and financing activities, it provides a clear view of liquidity and financial health, ensuring transparency for stakeholders. ASC 230 applies to all U.S. public companies, effective since 1987. Private companies following U.S. generally accepted accounting principles also need to comply. The key requirement is breaking down cash flows into operating, investing, and financing activities. This breakdown enhances analysis by allowing investors to see exactly where cash is generated and used, improving decision-making capabilities. The cash flow statement model takes raw financial data and paints a clear picture of cash inflows and outflows. By categorizing these flows into operating, investing, and financing activities, it reveals a company's liquidity dynamics. This model is essential in interviews, showcasing your ability to interpret financial health. Understanding how operations, investments, and financing impact cash flows gives you an edge in analyzing business performance. Understanding the scope of ASC 230 is crucial because missing exclusions like non-cash transactions with related parties can trip you up in interviews. Misjudging these boundaries leads to incorrect cash flow classifications, impacting financial statements. Grasping what's in and out helps ensure accurate reporting and makes you stand out in interviews. ASC 230 applies broadly to any entity preparing generally accepted accounting principles financials, explicitly covering cash flows from core operating activities like sales revenue inflows. It's crucial for transactions affecting cash and cash equivalents. For example, a retailer's cash sales or a manufacturer's purchase of raw materials fit here. Ensuring every cash impact from operations is captured is key to compliance. ASC 230 excludes cash flows from non-cash transactions with related parties, a common interview pitfall. For instance, barter transactions or stock-based employee compensation don't apply here. Also, investments in associates not consolidated are left out, which means cash flows from them aren't reflected in the standard's cash flow statement. Recognizing these exclusions helps avoid misclassification errors. Operating activities under ASC 230 encompass cash flows from an entity's primary revenue-generating operations. Imagine a retail store. Cash received from customers buying goods and payments to suppliers for inventory are typical. This category captures the essence of your main business activities, providing insights into operational efficiency and cash-generating ability. It's crucial for understanding core business health. Investing activities in ASC 230 focus on cash flows from long-term asset transactions. For instance, buying a new manufacturing plant or selling an old one fits here. This section reflects strategic decisions affecting future growth, impacting capital expenditure planning. It highlights how funds are allocated for long-term benefits, offering a window into the company's growth strategy and asset management. Edge cases often test your grasp of ASC 230's scope. Consider stock dividends. They're non-cash, so excluded. Cash flows from unconsolidated joint ventures? Not covered. Barter transactions with related parties also fall outside. Intercompany loans within consolidated groups might be complex, but typically aren't included. Mastering these nuances can differentiate you in technical discussions and interviews. Cash flow statements solve a critical problem: understanding liquidity in real time. Imagine a company with a $10 million SaaS contract, tracking every dollar matters. This model is the backbone of ASC 230, ensuring all cash inflows and outflows are visible. Let's see how this transparency is achieved. The cash flow statement model captures a company's liquidity by detailing cash movements across operations, investments, and financing. For Meridian Corporation, we track their $10 million SaaS contract over 3 years, noting $8 million for software and $2 million for services. It's a real-world scenario where transparency is key. In Step 1, we identify operating cash flows, the lifeblood of daily business. Meridian Corporation's $10 million SaaS contract with Acme Incorporated means $3 million this year from software and services is recorded here. The challenge? Avoiding the trap of misclassifying these flows with investing or financing. This step ensures we're only capturing core business activities. Step 2 tackles investing cash flows, capturing asset transactions. For Meridian Corporation, beyond the $3 million operating flows, we check for equipment purchases to deliver the SaaS service. Missing these capital expenses is a common pitfall. This step ensures we account for changes in long-term assets, critical for accurate cash flow reporting. Step 3 focuses on financing cash flows, capturing how companies fund their operations. Meridian Corporation may raise debt or equity to support their $10 million contract execution. This step follows from asset acquisitions in Step 2. The trick is keeping these flows distinct from operations to maintain financial clarity, ensuring financing changes stand out. In Step 4, we prepare the cash flow statement, merging flows into a coherent report. Meridian Corporation's $3 million operating cash, asset purchases, and financing activities from prior steps now come together. Using the direct or indirect method is crucial, with the latter adjusting net income to cash. This step ensures the comprehensive picture of cash movements is clear and accurate. Step 5 is about reconciliation, crucial for indirect method users. Meridian Corporation adjusts net income to align with the $3 million operational cash identified earlier, ensuring accuracy. This step corrects for non-cash items, like depreciation, bridging the gap between accounting profit and actual cash flow. It's the final polish on a comprehensive cash flow report, highlighting true liquidity. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Understanding ASC 230 ensures not only correct initial and subsequent measurements, but also the transparency through mandatory disclosures. Your team's reporting accuracy and credibility depend on mastering these concepts. Initially recognizing cash flows requires careful consideration of the fair value on the transaction date. For instance, when a company receives a $100,000 loan, it records the cash inflow at that value. Ensuring that cash flows meet the asset or liability definition is crucial, especially when materiality thresholds come into play. Subsequent measurement involves periodic reassessment of cash flow valuations. If market conditions shift significantly, this triggers a need for remeasurement. For instance, a rise in interest rates impacts the discount rate applied to future cash flows. However, minor fluctuations often don't necessitate revaluation, keeping reporting streamlined and efficient. Presenting cash flows involves clear classification into operating, investing, and financing categories. For example, dividends paid appear under operating activities. Significant transactions need detailed note disclosures. A $1 million equipment purchase financed by debt is disclosed, though not included in the cash flow statement, ensuring transparency without cluttering. Key disclosures under ASC 230 are crucial for thorough analysis. Disclosing major components provides clarity on cash flow origins. Reconciliation of net income to net cash offers insight into operational cash conversion. Additionally, non-cash activities, like a $500,000 asset trade, must be disclosed to ensure full comprehension of financial movements and impacts. Handling cash flow. Under ASC 230, a CFO might assess a $2 million lease. Lease payments fall under financing activities, ensuring accurate classification. Detailed notes explain lease terms and cash flow impacts. The CFO analyzes foreign exchange effects for precise reporting, aligning cash flow statements with strategic financial planning. This holistic approach maintains transparency and accountability. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. The lease agreement requires recognizing a right-of-use asset and a corresponding lease liability. ASC 230 mandates this, as Meridian Corporation now has control over the warehouse. This impacts the balance sheet by adding $500,000 under both assets and liabilities. Paying the first lease installment reduces the lease liability and cash by $500,000. Under ASC 230, this payment reflects Meridian's financial obligation fulfillment. The reduction in liabilities improves the company's net working capital position. The right-of-use asset is depreciated annually at $100,000, aligning with the lease term. This treatment under ASC 230 shows asset consumption on the income statement, reducing net income by the depreciation expense. Interest expense is calculated on the remaining lease liability balance. ASC 230 outlines this to reflect the financing cost associated with the lease. This impacts Meridian's income statement, increasing expenses by $25,000. Year-end adjustments ensure accurate reflection of accrued interest on the lease liability. Under ASC 230, these entries prepare Meridian's financial statements for external reporting, affecting liabilities and demonstrating payment obligations. The second lease installment diminishes the lease liability, reflecting ongoing fulfillment of Meridian's lease obligations. ASC 230 ensures these reductions mirror the actual cash outflow and financial commitment reduction. Derecognition of the right-of-use asset signals the end of the lease. ASC 230 dictates this to reflect asset disposal. Meridian's balance sheet no longer holds the asset, demonstrating the completed lease lifecycle. Every Big Four and investment bank interview on ASC 230 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 230 is the standard for statement of cash flows. It ensures clarity on cash inflows and outflows, crucial for stakeholders to evaluate liquidity. A common error is mixing cash flows with net income. Remember, cash flow affects liquidity directly, unlike net income, which is more theoretical. Always think cash first. ASC 230 mandates categorizing cash flows to enhance clarity and analysis. Operating activities show day-to-day cash flow. Investing indicates asset acquisitions, and financing reflects capital changes. Misclassifying these can confuse stakeholders. Ensure each cash flow aligns with its business nature for accurate financial analysis. Cash from asset sales is recorded under investing activities. ASC 230 distinguishes inflows from sales of property, plant, and equipment as investing, not operating. The pitfall is misclassifying it as operating cash flow. Accurately classifying ensures stakeholders understand the company's investment strategy and asset management. ASC 230 aligns closely with international financial reporting standards, but Indian accounting standard allows more flexibility in classification. For example, interest paid can be operating or financing in international financial reporting standards, while it's consistently operating in ASC. Avoid the trap of applying one standard's rules to another. Know the nuances for accurate reporting. ASC 230 requires translating foreign currency cash flows at the exchange rate on the date of cash flow. It prevents exchange rate gains or losses from appearing in cash flow statements. The common error? Using average rates. Ensure precision for each transaction date to avoid misreporting. The direct method lists actual cash receipts and payments, providing clarity but requiring detailed records. The indirect method starts with net income and adjusts for non-cash items. Many prefer the indirect method due to simplicity, but be wary of the lack of cash operation specifics. Start with net income, then adjust for non-cash expenses like depreciation, changes in working capital, and gains/losses. Common error, ignoring non-cash items. ASC 230 demands clarity in converting accrual-based net income to cash flow, highlighting cash-generating efficiency. Precision in adjustments is crucial. Dividends paid are classified under financing activities, while dividends received go under operating activities. This distinction helps stakeholders understand cash allocation decisions. A common trap is categorizing dividends paid as operating due to their regularity. Always align with ASC 230's strict definitions. Non-cash transactions, like stock issuance for assets, must be disclosed separately as they don't impact cash flow directly. ASC 230 requires clarity in these disclosures to ensure investors grasp all transactions. The challenge is ensuring completeness and accuracy, avoiding understated financial positions. ASC 230 focuses on cash flow presentation, helping stakeholders understand cash generation and liquidity. It covers all entities needing cash flow statements. Cash equivalents are short-term investments under 3 months. Operating activities exclude financing and investing, while investing covers long-term asset transactions. Financing activities relate to equity and debt cash impacts, offering a clear financial picture. The direct method gives detailed cash flow info, while the indirect method simplifies by adjusting net income. Interest and dividends classification depends on the transaction type. Non-cash investing transactions are disclosed separately. Foreign currency cash flows use transaction date rates. Total net cash from all activities must reconcile with the balance sheet, ensuring consistency. Watch for cash flow misclassification traps. ASC differs from international financial reporting standards, mainly in interest classification. Key disclosures include non-cash transactions and reconciliations. Common errors arise with indirect method adjustments. Foreign operations require precise cash flow conversion and classification. Practical expedients allow some reporting simplifications, aiding compliance and clarity. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.